Hello and welcome to Policy Watch. It was a bloodbath at the Chinese stock markets through the last week. They ended the week about 8% down, continuing a rout that's been on for months. Investor confidence stands shattered and word of a withering China growth story have hit markets in Asia, Europe and the United States. Now, what's the road ahead? Before we pick up on our discussion, here's a report.
That China stock market bubble had burst as far back as June after doubling over the previous 12 months. A surprise devaluation of the yuan earlier this month confirmed a sharp dip in China's industrial activity, but the government had no bold new market interventions. $3.25 trillion have been wiped out since June. As world markets were hit, foreign governments were quick to blame China for the crisis.
These stock market difficulties seem to be associated with a bit of a bubble in China and fears about a slowing Chinese economy. The good thing is that we haven't seen any ramifications from the stock market in capital markets more generally.
Amid a worldwide rout, a silver lining emerged from the US. Good quarter results there meant most global indices, London's FTSE, Japan's Nikkei, South Korea's Kospi, ended the week in the green. Despite the gloom in China, hope does make a surge.
This time, I think the investors are interested in buying again because markets rebounding, and investors want to know whether this is a good time to buy. And I give them the confidence that you can just go ahead and buy. Everything will rise.
In coming days, China's leaders could cut interest rates further, relax rules on bank lending, or increase spending to control the rout. Chinese pension funds are expected to begin investing a massive $300 billion in the country's stock markets to end the volatility. Stemming the market tailspin will be priority. Krishnanand Tripathi's report for Rajya Sabha Television.
Well, joining me now is Mohan Guruswamy, Senior Economist, KG Narendranath, Deputy Editor at the Financial Express, and Bhattacharya, former Vice Chancellor at the JNU. Gentlemen, thank you very much for joining us. So the first question is, we'll come to India in a moment, but let's understand what is China doing to the world. And Mohan, why don't you go off first?
China, for 2 decades, has contributed the biggest chunk to world GDP. In the 2 decades, out of the $2 trillion, GDP or $20 trillion went up. Chinese give half of it to growth. So, the world is reliant on Chinese growth to that extent. China also met this huge hunger for in the US for Chinese goods, cheap goods, and mind you, 90% of China's exports are still low-grade, low-aggregated goods, which involve huge number of labor. Shoes alone, they export $38 billion worth of shoes.
Okay, so light engineering,
light
consumer
engineering,
goods.
Not even that. Toys is another 40-50 billion.
Okay.
And shirts are 30 billion. So like that, you just keep adding. It's all low.
So what went wrong then?
No,
and so fast?
What has gone wrong is that, one, the Americans are clearly and definitely trying to bridge the trade gap. Obama has declared that by 2018, the US will not have a trade deficit. And that's the target. And they're also quietly, progressively devaluing. So what is happening is the Chinese are having problems with that market because there are cheaper producers coming in. Vietnam, Indonesia, all these people who are nibbling away at this. These are jobs where if you take away the shoe manufacturer from one factory in China, it goes to Indonesia easily. But what happens is that it displaces thousands of people in China. Now, with the last 2008 slowdown took place, one shock, they lost 22 million jobs because, this market tightened up.
Okay, so let me get another view and then we'll come back. Professor Bhattacharya, what went wrong so suddenly? It's almost like a conflagration, right? I mean, which is what we witnessed.
2 major things happened. One, China attained double-digit growth 3 consecutive decades. That was exactly the period after which Japan, Korea, Taiwan began the meltdown. $5,000 GNP is a sort of a benchmark, roughly from which you reach the optimum scale of return diminishing. But more important than that, the global meltdown has affected Chinese exports. China exports 60% of its manufacturing. And manufacturing accounts 60% of Chinese.
So when you say
GDP.
meltdown, do you mean the 2008 meltdown or?
2008 onwards,
Okay.
stagnation. And the recent European crisis, Chinese exports, light consumer goods, hit drastically. The global demand for Chinese exports slackening, which means Chinese industrial production, more than half it exports. And industry accounts for China more than 60% of GDP. So the exports slackening slowed down industry, industry slowed down the GDP. Two things combined was partially anticipated. In fact, Xi Jinping was trying to somehow have what we call soft landing rather than hard bumping. But soft landing apparently did not occur,
Right.
because stock market was not willing to adjust. They generally remained always all over the world hype economy. Where Xi Jinping was trying to cool them, have what we call soft landing, slowly adjust.
Right.
So they did not.
So two of the points that you've talked about, and let me come to Mohan and then Narendranath. So, you know, there's currency and there is the stock markets, right? So the most visible part of this was obviously the stock markets falling through the floor.
More than anything, the world got used to the notion that the Chinese can effectively micromanage their economy. What really happened here...
And they did try that.
No, they did try it, but what really happened here was also that they were not able to manage it. Now, at the time when, you know, the stock market was rising to these precipitous levels, the banks were actually lending money. The banks lent $500 billion to traders as margin to buy shares. So they were heating up the market. And the central government obviously didn't spot it or didn't act quickly enough to stop it. Now, when they come in with all the other reactions later, it is an afterthought. But, you know, in India, that would have never happened. The stock market heating up, the regulators, the RBI, everybody will be watching. And it will step in.
Okay.
In China, it didn't happen. So to that extent, we are getting used to a new China where there is failure of policy also.
Right. So let's understand the impact now, right? So the impact has been felt across the world, including in our region, which is Southeast Asia. Currencies have been depreciating along with India. Exports have been hit. And of course, that combines with a situation where many economies are already weak or are not, or are facing pressure on various fronts, including India.
Yeah, there are different reasons why,
Yeah.
you know, India is not doing well in the export front, basically because the Middle East has slowed down. Because oil prices are down, so their ability to import has come down. You know, whether few people realize the United Arab Emirates was our leading trading partner, number
Yes.
one trading partner.
Yeah.
So, you know, that is cooling off. Saudi Arabia and all these countries are cooling off a bit. Central Asia is holding off. Europe has been in prolonged trouble, as Professor said. So, you know, and we don't really export very much to America, except software, which is still continuing quite well. But what's happening in other Southeast Asian countries is they are taking away manufacturing from China. And so Chinese are competing with them. They're not competing with us on the labor markets. They're competing with Indonesia, Malaysia, Vietnam, and all for cheaper labor. And so their devaluation will hurt them. So they are devaluing. It's a competitive devaluation resonance, you can call it.
So what's the outcome of this as we stand today?
The outcome is, as Raghuram Rajan time and again warned, that competitive devaluation is not in our interest. That you've got to hold off.
Okay.
You know, and this is something which the world has to come to listen. If you start this competitive devaluation, or, you know, you can have regulation of markets, then you're going to get into some kind of difficulty.
KG, what's your sense? I mean, I'm going to come to India in a bit, but we're first trying to understand what has happened in China to the extent that has impacted large parts of the world, particularly the industrialized world, and then we'll try and understand what that could do to India.
You know, generally the global demand is weak. So that has an impact on across the globe. You know, the IMF projections for growth also we see, or the world trade growth, these are all very muted. So that has an impact on China's growth also. So China is trying to rebalance its economy with consumption-led economy. They are trying to investment-led economy. They are trying to be more consumption-led, and the export dependence they are going to decrease. That process is already on. For India also, actually, if you see that after the 2008 crisis also, both India and China managed soft landing. But in India's case, actually the dip in growth was even more pronounced than China later on. That's because we are also, as generally believe that we are not that export dependent, so exports are not that important for us. Domestic demand is more important. But we are also increasingly becoming export dependent. If you see, our service exports are stagnating now at around 8%, whereas the manufacturing exports have seen an increase. So the export dependence of Indian economy is also increased. So what happens on the globe, it is not very wise to assume that it won't affect us. Even though the fundamentals of our economy are very strong, we also had an impact of the global demand, and it will be more pronounced in the unless we take remedial measures.
Another reason why India slowed down precipitously that time, you see the budgetary figures, the appropriations for subsidies went up hugely, and capital investment kept coming down. So, even though we are insulated against what really happens outside to a good degree, but you can also shoot your foot inside. And it coincided at the same time.
So that's why it's important to improve the productive capacity of our economy.
Right. Yeah. So I'm going to come to the India part in a bit, but let's understand the impact of China again. So, Professor, are we ready for a world where China is not playing a leadership role in the global economy? See, or have we sort of got completely used to it, as Mohan was saying?
China is playing its own role, irrespective of what the world is thinking or world may happen. Chinese policies have never looked into the globe as to adjust. They say it is our domain, we shall do what we want. Luckily, they have the world's largest furnishing reserve ever. Second, Chinese economy is still controlled economy in many respects. Banks, financial institutions. Even the large firms are still under the command of the party. So what China is doing, Xi Jinping, an additional factor compounded. He is going hard on the corruption. That has affected many industrialists, many stock market players. There is a
and revenues in Macau.
And revenues in Macau. So there is some bit of, they say, revolt by people affected by the corruption to teach Xi Jinping, you go too much hard against us, see what will happen to your stock market.
Right. So, Mohan, quick word on this. So, are we ready at all for a world where China is not playing a leadership role, or China's leadership role diminishes and it could really have an impact which we've not thought about?
I think the notion that China leads the world is exaggerated.
The manufacturing world?
Not really. China is a supplier. I've never known of a situation where the supplier calls the shots. It's the buyer who calls the shots. The United States is the buyer. It pays by printing notes. And it has this huge fiscal deficit year after year. And it shows the confidence that people have in the US dollar. And it pays to China with notes. And the Chinese then park those notes in American banks. If you have $4 trillion reserve, do you think if the Chinese go and ask the Americans for the $4 trillion, they'll give it back?
Professor, last word before we go for a break.
What the world has to now realize, China is not going to go back to 10% plus growth rate. That phase of the growth of China is over. Infrastructure is built almost complete. Huge overinvestment, close to 50%.
Coast towns.
So China will be now gradually coming down 5, 6, 7% growth rate. And even that will be a very great growth rate. So what will happen is, China will have to adjust to slower growth and probably slower export growth. That's a good news for the rest of the world. No matter how hard China will devalue, the world demand is slackening and Chinese export growth will not be able to go to that extent.
Right. Okay. So that's a good note to end this segment and talk in the next segment about how this could impact India and what are the lessons for India, if at all. Stay with us here with Policy Watch. Welcome back. The Indian stock markets took a beating on Black Monday on China tremors, falling more than 1,600 points, but they picked up the very next day on positive sentiments from the US economy. Now, indications are perhaps that any downturn in China might not hit India so hard. Here's a report.
It was a bear hug in China, and for India, there was no escaping the tremors, at least immediately. The BSE Sensex closed all of 1,625 points down on Monday, its biggest fall in 6 years, its third biggest ever.
There is not a single domestic factor in India which has either contributed to it or has added to it. Now, these are external factors. I have not the least doubt that this turbulence is transient and temporary in nature. The markets will settle down.
but a sense of stabilization began even by the next day. By the end of the week, the BSE made a sharp recovery on the back of better-than-expected US GDP data that grew 3.7% in the second quarter. The US Fed's hints on delaying a rate hike also helped boost sentiment. By the weekend, both the BSE and NSE had recovered their losses, raising optimism that the Chinese crisis can be turned into an advantage.
A certain amount of turmoil, markets reassess fundamentals. And when they do that reassessment, they will see that India is a good place to be.
India is also set to gain from cheap global oil prices as they hover around $40 a barrel. Low crude prices have helped India control its current account deficit. Another advantage for India is that both wholesale and retail prices are at a very low level despite a weak monsoon. That may actually allow India's central bank to lower rates to boost the economy. Krishnanand Tripathi's report for Rajya Sabha Television.
Well, still with me are Mohan Guruswamy, BB Bhattacharya and KG Narendranath. Okay, so we talked about China and the impact on the world, and now we're trying to understand if indeed China will have such an impact on the world, but more importantly, what's the impact on India going to be? So let me quote one statement by Arvind Panagriya, the Vice Chairman of the Niti Aayog. He says that China's loss is India's gain. State governments could take the lead. He also said that China is vacating space in the export markets. Now, many others have echoed similar statements. The question is this true? Professor?
It is an ambitious program. The reason being, the space that will be vacated by China will be picked up by Vietnam, Malaysia, Thailand, Indonesia. Because India, whichever industry you pick up, we are not competing yet in any of them with them. So it is our aim, no doubt, if we can successfully complete all our reforming agenda, and that takes time. After that, the impact go down to the industry, production, technology level. It will still some more years. So India, you may say, long run. We don't know when this long run. But right now, the tab will be picked up by others, right. South Asian economies.
So, KG, apart from the fact that whether, we will gain immediately or not, the fear is that our belief that we are protected at this point will actually prevent us from doing perhaps harder reforms that we are supposed to do.
No, I agree with Professor that we are not in a position to gain from it immediately. There are areas where we compete with China. Unlike what you said in textile and garments, for example, India is a major competitor to China. And this is a major chunk of our exports also. So there already they have a huge competitiveness because of synthetic textile advantage, because of policy issues which were hampering India's textile sector. But if you see the major markets like US and EU, there are duty-free access to EU and US from various Canada and all various other markets. This is already a disadvantage for India. So if China devalues further, it can be even more a problem for India. And also, the important point is that we have not prepared ourselves to immediately seize the opportunity. We need productivity enhancing reforms in the country. We need.
Give me an example of.
For example, the GST bills have been, cost will have to bring down. We have to bring down the cost of manufacturing in India. If you see the capital employed, the efficiency of capital employed also, it has come down dramatically over the last many years. So we have to restructure our economy. If we had restructured our economy in advance, then we would have been in a position to seize the opportunity now. But right. Unfortunately, we have not done that.
Right. So, Mohan, do you think that we are in a position to actually capitalize? We've got too many problems of our own to fix before we talk about even...
I don't think so. We'll only pick up something on the ends and on the bends. But I don't think our labour costs are much higher than Chinese labour costs in the organised sector. It's by a factor of 4:3. So, forget about China. We can't compete with China, let alone Indonesia and Vietnam. So it's not going to happen. And so you need reforms. It's entry into industry and exit from industry has to be made easy. We have to start treating new industries as valuable assets, as valuable additions to our economy, and therefore encourage them. So we don't really, all the impediments you get towards setting up industries is huge. And then, there is a sweatshop element in this huge growth of these countries. I went to the iPad factory in Chengdu. It makes, iPads and iPhones.
And it will sure do the same thing in Maharashtra as well.
Well, not really. This factory, the Foxconn factory, is 5 kilometers long. It employs 2 lakh workers. They all stay in dormitories inside the factory. And they work 10 hours a day is norm.
So let me ask the corollary question, right? So we've also seen a fall in commodity prices. I mean, very sharp reduction. In the last 12 months, commodity prices have almost halved. So isn't that a benefit, as some people are arguing? Professor, then...
Yes, it is substantial benefit, but we can't depend on it forever. Commodity market always moves in cycles. If you look at last 40, 50 years, average 3 to 5 years, it will keep cycling. So if we make a long-term policy, assuming that all this oil and copper and prices will remain low, then we will be in a bad soup. The route that we have to take, the point is, we're talking about it, but not enough done. What is the problem with Indian labor versus China, apart from wage and everything? Indian labor is unskilled. 90% of Indian workforce is without any formal minimum education. So if they have to assemble the mobile phone, they can't. They can't assemble computer. So higher value products, they are zero productivity. What will happen? Vietnam, Thailand, Malaysia, Indonesia, they have been lining up these activities for some time. They lacked knowledge of English. Now they're picking up very fast English. Already Philippines has crossed India in BPO service from last year.
Yeah. So what you're saying is there are large chunks of potential manufacturing or services opportunities which will migrate straight from China to other countries if China were to lose out as it is currently.
India can, if we can.
But is there some other opportunity for India then, Mohan?
Well, the opportunity for India, the opportunity is that we have to reform internally. We have to increase our manufacturing base, step up industrialization. That has to be done internally. We'll have to lead it ourselves and, seriously say, why is it not happening? And we've got to do it. Like Uni was saying, that unless you industrialize and therefore, create more jobs, you're adding 12 million people to the workforce every year.
Okay. So let me ask the next question, right? So do we also need to be in a state of preparedness, which we touched upon earlier, to protect our economy? I mean, so there was this discussion on comparative devaluation. Now, that's one part of the story. But do we need to be more alert to ensure that things don't hit us out of the blue?
Yes,
and
very
how?
Much.
Yeah.
You see, what is going to happen, China have created capacity for production, steel and other, huge quantum. Now, their investment program is slowing down, infrastructure program is slowing down. India is still growing. So what China is going to do, already you are feeling in the pinch in steel, dump a lot, and with devaluation, they are going to bring them to India and sell. Now, they are competing with Indian steel. Unfortunately, Indian steelmakers have not thought about it. They were thinking there's a global rise of demand for steel, so we can continue irrespective of competition from China.
And you're saying the higher tariffs which are not really
China is going to contest in WTO. We are violating the WTO.
Okay.
So very soon, WTO takes a little bit of time. We have entered WTO agreement not more than 10% tariff on any industrial goods. So China is going to take us on WTO.
I'll tell you one thing, after having been in the government, the import lobbies are much more strong and influential in the halls of government than the manufacturing lobbies. The guy who manufactures steel doesn't have the same clout as the guy who's representing a Chinese steel company. Because, he is operating quickly at the margins, moving fast.
Right.
So, we don't have a trade office. The United States has a trade office which has about 800 experts who are constantly monitoring commodities. We have 5 people in Commerce Ministry.
Okay. So we're running out of time. So let me get, the quick do's and don'ts for India as an economy to be better hedged in future and perhaps grab some opportunities. So let me begin with you, KG, and then we'll go this way.
For the economy, we have to do taxation reforms. The goods and service tax, which will reduce the cascading effect of taxes.
So all this is pointing out is fundamentally our own flaws in not having reformed quickly.
Then the labor reforms, of course, is very important we have many labor-intensive sectors which are export-oriented. China is moving away from labor-intensive sectors, and the labor cost also has gone up there. So we have to do reforms to help those sectors which are labor-intensive.
Okay.
Then it is also important to know the productive capacity of the economy can be increased with other measures like, we have to, the government public expenditure. can be spent more, especially for investment.
As it is happening already.
In the government expenditure.
To some extent,
happening not to the desired extent.
Yeah.
There's a talk about it, but it's not actually happening to the desired extent. So government has to spearhead the investment-led consumption.
Okay, Professor, any don'ts?
Luckily, our agriculture and services will not be touched by anything to do with China. It's only industry that will be in problem. But services, we can still improve our productivity and outbeat the loss in industry. But industry will take a longer time too, unless we work footing, do something on making India's skill formations. It will take time. But services, we still have scope because we still have the skilled professional people of India capable of doing the global services servicing.
And is there a don't? I mean, we talk in the context of really ensuring that we are more secure than perhaps we are today or were recently.
Don't says not be complacent on foreign exchange front.
Okay. Mohan?
I agree. We've got to be careful and we've got to also...
So once again, when you say don't be complacent on foreign exchange, you mean what? You mean more intervention?
The interest rate policy of the RBI has to be carefully calibrated. Because there is a tremendous political pressure to bring the interest rate. Already banks and others are NPAs are very high. And if industry is not getting much demand in any case, the only sector that will borrow is real estate. They are desperate to borrow, and Reserve Bank should not fall in populism.
Right. And of course, clean up the banking system, though that's a different discussion. Yes, Mohan. Do's and don'ts.
Well, I think clean up the banking system has to go on. I mean, this has become excessive now, because now out of the top 50, 40 have got NPAs. And, are really borrowing money to pay their interest. So you can't have this kind of system. You can't have this excessive cronyism. So, interest rates have to come down. And, people who have borrowed have to pay back. You're
saying interest rates have to come down?
Have to come down because, we can't go on at this 9-10% interest rate, because it's effective lending rate is 12-14%.
Better way to reduce banks' NPAs. And that have operational efficiency and have the interest rate.
And then, so you got to handle those things also simultaneously. What you really need at this thing is a kind of a SAR who can see many things at the same time. The problem is that our system doesn't have that. We have too many independent heads, each neutralizing the other. So I think we need to get our economic management into control.
A trade office is what you said, or a
among
larger...
Among other things, I think you need a China policy office because it is a big player in the world market, big player with us. We have a trade deficit of about 48 billion now with China. You've got to be watching it carefully. You've got to watch, this is the time to sign up long-term oil contracts, to sign up pipeline contracts. So somebody got to be watching all this. PMO is always firefighting. You need somebody to sit back and watch and take stock of this. So I think I'm waiting for that day when that happens.
Okay. And last question quickly, and let me ask you, Mohan, but you expect a more volatile economy and world in the next 3 to 6 months?
I don't think so. I think it is going to settle down.
Okay.
One thing we have learned is that, China can't be relied on to deliver the world growth alone. Actually, India is in a demographic situation where we will have the accretion of 180 million families into the middle class in the next 35 years. So where will the goods for those middle class come from? The refrigerators, the cars, the scooters, the motorbikes, all these things. So the demand will be led in India to a large extent. So how will we pay for that demand? Is also something
key is do something about the domestic economy and make sure that reforms are accelerated, old as that sound, but that's still the mantra as we end today. Thank you very much for joining us. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.